Financial mismanagement is responsible for most business failures in the world.
What are some of the most common mistakes that you've seen companies make?
The bigger mistakes are when they use short-term money for long-term purposes. You bring me 10 companies, 6 companies' balance sheets, I'll probably show you 7 or 8. That in America, 9 out of 10 companies routinely fail to earn even the cost of capital invested in them. The scary part is you don't even know it.
What would the framework be that startup founders should adopt?
You need to understand the impact of your actions on, number one, the company's bottom line, and number two, on the cash flow. These are the two pillars on which your successful business stands.
I also want to talk about the US debt crisis.
The US added $100 billion to its debt.
America's debt crisis.
Since 1971, when Nixon exited the gold standard, the dollar has no moral right to be the world's reserve currency.
What do you think of India's economic health right now?
India's finances are managed better than many other countries right now.
All of us should believe in ourselves. We should believe in our economy.
Being an optimist by nature, I think the next 50 years belong to us.
In India, we're always told that debt is bad. Stay away from that.
These are all mindsets. That is not bad. That is one of the best things you can use to grow. Make sure when you raise money, if you can earn greater than what the debt costs you. If these two conditions are not violated, the more you borrow, the more you will prosper. Unproductive debt, absolutely no. But productive debt.
And you also said less is bad and more is worse.
Less is bad, we can readily understand. If you have less manpower, then you need some functions won't get performed. What people don't understand is more is.
Hello and welcome everyone to the India Opportunity Show. I'm your host Shrishti, and today I'm thrilled to introduce you to my guest, Dr. Anil Lamba, an author, an educator, a chartered accountant, and one of India's most respected voices in the world of finance. He literally teaches organizations how to become financially intelligent. He's also the mind behind bestsellers such as Romancing the Balance Sheet and Flirting with Stocks. Recently, he's been turning heads with his macro insights, whether it be decoding India's balance sheet or talking about de-dollarization and the US economy. In today's conversation, you'll get to hear what's really going on beneath the surface, the real opportunities, real risks, and the timeless principles that smart decision makers and capital allocators should always keep close to their hearts. Hope you enjoy watching. India is one of the fastest growing economies around the world. And if you want to participate in this fantastic growth story, you need to be backing Indian businesses and companies. Whether you already invest in markets or are just starting out your journey, Grow is the place to be. Grow gives you a clean, simple, and intuitive experience unlike anything that you would have experienced before. You can track your portfolio performance, track sector-wise distributions, and get an overall comprehensive view of all your investments just with a few clicks. You can invest in stocks, IPOs, mutual funds, commodities, ETFs, all in one app. No wonder Grow has now become India's largest stockbroker with over 1 crore active investors. Check out the link in the description for more details. Hi Anil, welcome to the India Opportunity Show. Thank you for joining me here today.
Thank you for calling me here.
You've had such a fantastic journey. You were here for a training program, but what I enjoyed the most recently is the kind of content that you've started creating on YouTube. And like I was just mentioning, I binge watched a lot of those videos. Your most recent topic, where you spoke about India's balance sheet, I think that is something that would be very interesting to start with because, I don't think anyone had explained India's balance sheet and budget the way you did in the video. Let's start with that and then we can take it from there.
Yeah, it wasn't really a balance sheet because a lot of people wrote on that. You said balance sheet and we were looking for the balance sheet, but I started with a question saying, have we seen India's balance sheet? We should. So what comes nearest to it is, let's say, the budget that the finance minister presents. So then started on that. How does the country get its money from? Idea is finance management, whether it is in individuals or it is the countries. So a country receives money from two areas. It earns and it borrows. Earnings happen through taxes and borrowings are internal and external. Internal borrowing being every time you and I save money to save taxes, for example, it's a loan to the government. And then they borrow externally. Money goes into two areas, partly towards creation of infrastructure, partly towards running the country. So in that video, I was talking about, if you and I make our budget, we'll probably first look at the income side. How much can we earn? And then plan the expenditure. Governments work in the reverse. They first plan where to spend. And then they figure out where will it come from. But sometimes it comes, sometimes it doesn't. So if it doesn't come in, if what comes in is lesser than what goes out, then they need to print.
Yeah.
You and I can also spend more than what we earn. We can borrow, but government printing means the spending is greater than earnings and borrowings, which you and I can't do. So then the question is that good? Is it bad? What are the repercussions? I don't know. I just took off without any agenda. It was a free-flowing kind of a thing, but seemed to have got a good response.
Yes, but what do you think of India's economic health right now? From a financial lens, since you understand these things so well.
I think India's finances are managed better than many other countries right now. Sometimes when you praise the government, people attribute political motives to it. In one or two comments people said, but that's not the case. I have been a die-hard fan of India's finance management since 1991 when we started the liberalization process. And I think because my firm belief is anyone who manages finances better does well for whether it's an individual or a country. So post 91, we will notice most of the upheavals that happened in the world, India was not much affected. If you look at the subprime crisis that took place in the United States, after that, I think the world went topsy-turvy. Nothing happened to India. And I attributed most of it to India's finance management. And of course, partly it looks like its time has come. It's a country whose time has come. All our negatives became our positives. For example, our biggest negative all along used to be population.
Yeah.
And today our biggest strength is the population. People perceive it as a market. Our biggest weakness was and is the black economy. But the black economy saved the country from going under during the subprime crisis. Now, what happened during the subprime crisis? The real estate market crashed. So the mortgage, the loan taken was higher than the value of the property. In India, it can't happen because there's a black economy.
Yeah.
You buy a 100 rupee worth of property, first the guy says, pay me 60 in check. Then again 60, the bank says, I'll give you 80% loan. So your margins are so high, you can't ever. So I think it looks like its time has come. So all our negatives are going in our favor. And the country's finance management is also fairly good. So I think all these things augur very well. Being an optimist by nature, I think the next 50 years belong to us.
That's amazing. And here, I also want to segue into de-dollarization and the US economy because, there is a sense of changing world order. Everyone is talking about how dollar shouldn't be the world's reserve currency. And there are also alternative currencies that people have started looking at. Bitcoin has gotten a lot of favor from institutions as well now. So, there is a sense of shifting world order.
Completely.
Where do you think, the US economy is currently and what impact would it have on India's growth?
I'll give you my two bits, but disclaimer being, I'm not an economist, I'm a chartered accountant. I like these topics, so I keep reading. So whatever little I understand, de-dollarization is long overdue, according to me. I mentioned in that video of mine that since 1971, when Nixon exited the gold standard, the dollar has no moral right to be the world reserve currency. But you can't find a substitute. And US has also been ruthless with any substitute that even shows signs of surfacing. So theories are Iraq war was mainly because Mr. Saddam Hussein said, I'll trade in euro. I'll buy oil in euro, not in dollars. So they couldn't afford that kind of a thing to come up. In Libya, Mr. Gaddafi, same. He made similar noises, and he paid the price for it. Not too long back, Turkey, Erdogan was so a lot of problems he had to face. So US deals ruthlessly with any sign of a threat to the dollar. I think what Mr. Trump was most worried about was BRICS coming out with a different currency. But I think now it seems to be inevitable. Circumstances have created themselves in such a way that there seems to be an alignment between Russia, China, and India. And BRICS is becoming stronger. I read somewhere the other day Japan has also joined the BRICS. So the end seems to be near. It may not happen suddenly because it's just gradual shifting. One doesn't even realize. But I think the percentage of world trade happening not in dollars is becoming bigger every day. So US has enjoyed for a long, long time the benefits of being the world reserve currency. Now I think it'll have to live with the fact that it won't be.
What factors do you think helped US dominate in terms of the becoming global currency?
No, what made them the reserve currency was the fact that they had a lot of gold. The single factor, because all the countries had exited the gold standard. In domestic trade, it's still okay. But international trade, you can't trust the currency if it's a fiat currency. And US had huge amounts of gold. They always had gold, then they earned a lot of money during First World War, in the period between the First and the Second World War, and during the Second World War. They were the major suppliers of arms. And you don't accept money in currency during wars. So they received money in gold. I mean, they received payments in gold. And then I think several countries found it safer to keep money in the US, keep gold in the US because of the dangers of war. So end result was US was the only country that had a lot of gold. And the world said, okay, US, only the dollar will be printed against a reserve of gold. And it was given the status of world reserve currency. And therefore, when Mr. Nixon exited the gold standard, according to me, the rationale was out. So moral right was gone. But if you don't find a substitute, prior to the dollar, the UK pound used to be the world reserve currency. And the UK, they exited the gold standard in 1913. So since then, they didn't have the moral right. But you didn't find a substitute till 1944, when dollar became. So similarly, since 1971, dollar doesn't have, but you still don't have a substitute. I remember many, many years back, maybe 15, 20 years back, gold prices had seen a spike. And since then, they never went back. And that was the time, China thinks so much in the future. It is their desire that Yuan should be the world reserve currency. And I think they've got all the boxes lined up, what is required to become eligible for that. And one of the key requirements is a reserve of gold. So they started accumulating gold as a national policy. That is where the gold spiked. China not only started collecting gold, I think they passed a diktat that every family should invest some 5% of their monthly earnings in gold. Normal people can't do anything but watch, but a few people who have the courage and who have the understanding make a huge profit out of it.
Yes. And here I think, because we just touched upon the stock markets, you've written an amazing book, Flirting with Stocks, and, that is to help younger people and adults also understand how public markets work. What are some of the timeless principles do you think apply to everyone? Because we were just discussing that, there have been a lot of new market entrants after COVID, but a lot of them don't really understand how public markets work, how cycles work, how boom and bust cycles work, etc. So a lot of them will be experiencing these things for the first time. What are some principles or guiding principles that you can share with them?
I think two things age old and apply always is number one, select wisely and then time your entry and exit. Timing your entry and exit easier said than done because very difficult to understand what will happen. So the first thing is to choose well, fundamentally strong shares. For that you need an understanding of finance and balance sheets and so on. When it starts falling is the time to get out. And one could be wrong because when you think it started falling, it may pick up again. Doesn't matter. So I've always said two ups. If the market is falling and it starts going up, once it has gone up, doesn't mean it will go up, it may fall again. So if it falls and goes up again, and two successive peaks are higher than each other, that's the time to get in. If it falls and it goes up again and falls again, and this time the bottom it touched is lower than the earlier bottom, two successive falls, time to get out. Not foolproof, but if you do it consistently, I think 8 out of 10 times, 7 out of 10 times, it will serve you well. So these two things, how to select a stock and how to time your entry and exit. And I think I meet two types of people. One who says, I don't invest in stocks. Second who says, of course I do. How many shares do you, how many scripts do you have? In the portfolio, there'll be 100, 150 companies. I feel you'll never ever make money because nobody can be right every time. So if you have such a large portfolio, at the best of times, half of them will be up, half of them will be down, you'll never make money. So I feel your portfolio should be in single digits.
Single digits?
Single digits. So
that's very high concentration. Usually
really.
People recommend 15, 20 companies.
Single digits, or one or two here and there. But then you have, then relatively larger amounts can go into it and you can devote time. It's worth it. I mean, if you have small quantities and a large number of companies, how many can you keep track of?
Yes, exactly. Position sizing, I think everyone struggles with, at least when they start, because, it takes so much time to feel confident in your ability to be able to pick the stocks, so to speak. So since you said that's your first thing that you need to figure out how to do, let's give our audience some frameworks to think about how to pick stocks.
I put one video out the other day because a lot of people said, come out with, I'm not a stockbroker. I don't do this as a living. I don't, just out of my, I may not be.
You do make people financially intelligent. So I think that's.
So mine is absolutely rock bottom common sense thinking. So I said, if I have to give you a shortcut for fundamentals, pick up a fundamentally strong share. I put a few criteria what you should apply not to buy. I said, criteria number one, once you've selected the industry, first start with the industry. Easier to do that. Find out which industry has a healthy climate, government policies are pro, and so on. Now the question is, within that industry, which share to buy? Here is where the fundamental analysis comes in. So to new investors, my advice is, don't go for the names you never heard of. Well-meaning friends will call you, pick up this share, and you never even heard of it before. So those are dangerous. Do it later once you become a seasoned investor. Initially, if you want to get into industry, stick to the names of companies that readily come to mind when you think of that industry. Now, still you may get half a dozen names. Now, within those half a dozen, which one to pick up? So I said a few criterion. Number one, whenever you're studying the data, go a little back, go last quarter, previous quarter, last year, previous year, and plot a sales graph. Make sure the sales graph is on the ascendant. I mean, there are thousands of companies to choose from. Why would I want to pick up the share of a company whose sales has either started stagnating or started dropping? So it should be up. Now, sales going up is very easy. I mean, if you slash your selling price, your sales can go up. It should be the right sales. So plot a gross profit graph, which should be at least linear. That means these are not bogus sales, these are genuine sales. And if it is growing little faster than the percentage increase in sales, huge brownie points. And if it is a little slower, don't touch it. Third criteria, net profit. Net profit should be growing at a pace faster than the growth in sales and gross profit. Because by the time you arrive at net profit, you've also deducted the fixed costs. And fixed costs remain fixed. So there's a leverage effect. So if your sales goes up 10%, net profit can go up 20%, 30%, 40%. So this graph should be converging toward the sales graph. And then look at the earnings per share. I feel the earnings per share, each one can set their own standards. You can say it should be put a number. But I feel take the industry average. Unless it is higher than industry average, you should not pick up the share. But then these criteria are helping you choose a fundamentally sound share, but that doesn't mean you should buy it. Yeah. It could be very expensive. I'm not buying a share just for the pleasure of buying a good share. I want to make profit out of it. So if it's already too expensive, I may not be interested. So then the last criteria is the price earning ratio.
Yeah.
So then make sure the price to earning ratio is below industry average. I mean, if you go for a cheap share, you'll get a lousy share. I don't want that. If you go for a wonderful share, you may get it very expensive. I don't want that. But these criteria will ensure that the share that you selected is a good one. Sales is up, gross profit is up, net profit is up, EPS. And at the same time, P is below industry average. Now I think you have a winner. So these are such rudimentary stuff that you don't even need any expert to tell you about it.
Yeah. Yeah, but like, in today's market, like over the last year, I think India's market has been a completely sideways market, as they call it, In fact, I was reading Chris Wood's Greed and Fear letter, where he talks about how this is last year has been the worst performance since 1996 for Indian market as a stock market, right? Because a lot of the stocks are actually very, very richly valued. A lot of them trading at, say, P's of like 50, 60 even, some above 100. So how do you find winners in this kind of an environment? Or do you just wait it out?
I frankly wouldn't know. I stick to single digit. I buy and then forget them. Sometimes I don't get time to even look at the market for months together. So I'm not, I like the stock market. I feel I've always said investing in stocks is a national duty. So I do my little bit in spreading, information about it. But if you ask me what happened yesterday, what happened day before, I may not know.
So then when it comes to, thinking about some financial health of different companies, I wanted to talk about, because you spend so much time training. That's
my area. That's my job. That's what I do.
So let's talk about that. How do you make an organization financially intelligent?
What happens is, first of all, financial mismanagement is responsible for most business failures in the world. And therefore, every organization has to become financially intelligent. If they are not, sooner or later, they'll pay a price for it. But the misconception is, people think financial intelligence or lack of it happens in the finance department. If your finance department is robust, your company's finance management is good. And if your finance department is weak, your company's finance management is weak. That is wrong. You can have the best finance department in the world and still your organization can suffer from bad finance management. Now, this sounds a little contradictory because very, very little finance management happens in the finance department. Finance management or mismanagement happens 24/7 in the actions of every individual in the organization. When the sales fellow out in the field sells on the wrong terms or the wrong price or give the wrong type of credit to the customer, or the purchase manager goes and buys at wrong prices or maintain the wrong levels of inventory, or the production guy does production scheduling which is financially not intelligent, or the HR person hires the wrong number of people. These are all examples of finance mismanagement. In fact, by the time the finance professionals come into the picture, it's already over. Either finance management or mismanagement is already done. So unless financial literacy goes top to bottom, the organization's finance management cannot be at its peak. Because, if you realize your production is weak, you tend to strengthen the production department. If you decide my weakness is sales, you'll strengthen your sales department. So when you realize my finance management is weak, you go and strengthen the finance department. And I think you are treating the symptom. Because finance management doesn't happen. Or All finance management doesn't happen in the finance department.
Because the damage is already done.
Damage is already done by the time the professionals come into the picture. And best part is, but everybody, all my clients have realized this before they came to us. In fact, therefore they came to us when the realization set in. So they are the pre-sold people. So what we do is we make sure the entire organization, financial literacy goes top to bottom. I have a concept called FIO, which is Financially Intelligent Organization.
Right.
FIO as opposed to FII. Let's say you are in a company and you attend a training program. We'll say we've now created a financially intelligent individual, but that doesn't mean the organization has become financially intelligent. Eventual requirement is to become an FIO.
Yeah.
It's the first of its kind in the world, probably like an ISO certificate. We'll certify your organization to be an FIO. Now, in order to be an FIO, two things are required. If you opt for FIO, then you can't tell me, Anil, train these 50, 100, 500 people. If your company has 10,000 people, I will train 10,000. Literacy has to go to everybody to the lowest level. But literacy is half the job. There's no point spreading financial literacy unless it is supported by timely and relevant data. You'll be amazed how often data doesn't get generated. If it gets generated, it doesn't get generated on time. If it does get generated on time, it doesn't reach the right people. If it reaches the right people, those people don't know what to do with that data. It's a deep-rooted problem. So we work on the information, we study the accounting systems, we study the reporting systems, we tweak the systems, we design customized MIS reports for them. We tell them which report should be generated with what frequency. We'll tell them which report should be given to which person. And we'll make sure by the time that person receives the reports, we have trained that person to read, understand, interpret, and take actions based on that. So when information gets generated, the relevant information at the right time reaches the right people, and they are trained to know what to do with it, then we'll certify you are now a financially intelligent organization.
That's very interesting, because a lot of people who watch this podcast are capital allocators themselves in the way of either being founders, promoters, or, leading family offices and board members even. So how would you help this audience evaluate the financial health of their company? What is the first step when you go into an organization?
That's too long an answer.
But how can one assess for the company's financial health?
You've got to learn how to read financial statements. If a doctor says, I don't know how to read a pathology report, how will he treat? So your data is being generated in the form of these statements. I've always said finance is the language of business. If you don't speak the language, you don't know what your business is trying to tell you. All the signs of trouble are there before the trouble has happened. If you could read that language, if you could see those signs, if you could take corrective actions before it became too late, you would not get into trouble. And trust me, 9 out of 10 businesses that get into trouble is only because of financial mismanagement. And a company getting into trouble due to financial mismanagement means it was an avoidable problem.
Yeah.
If somebody's business failed because the product was faulty, this guy made a cup which had a hole at the bottom. Now, he wouldn't be able to sell his cups and say, you deserve to shut down. But if the company shuts down because of financial mismanagement, I think it's a pity. Had you realized how important this is, your company would not have got into trouble. So we help prevent that.
What are some of the most common mistakes that you've seen companies make?
The bigger mistakes are when they use short-term money for long-term purpose. One of the biggest. You bring me 10 companies, 6 companies' balance sheets, I'll probably show you 7 or 8 which would have gone sick due to the use of short-term money for long-term purposes. One of the scariest things, I often give keynote talks to these entrepreneurs organizations and the FICCIs and the CIIs and there are a room full of entrepreneurs and you ask them how many of you know your cost of capital. A large majority would not. And those few hands that go up, they say they know. When I start quizzing them, their interpretation of that and mine are totally different. Now, if you don't even know your cost of capital, your business is not really a success unless your revenues generated exceed not only your cost of production, cost of admin, cost of selling, but also the cost of capital. Bain and Company, there was a report I was reading that in America, 9 out of 10 companies routinely fail to earn even the cost of capital invested in them. According to me, they are already in deep trouble and they don't even know it. The scary part is you don't even know it. So these are two of the many mistakes and things that are happening in organization. Unless you understand that and start working towards it. If you start working towards it, you're going to preempt this problem. Otherwise, you realize you're in deep trouble when you're already in deep trouble.
Yes. So. In fact, because I grew up in a business family, and I always remember my uncle saying that, if your cost of capital is 15%, then you should at least be generating 18 or 20% on top of it, so that at least you are making money as a business, right?
I'm tempted to take off from where you said, but then I won't stop for an hour. So I want
Please go ahead. Because I do want to dive deep into this fact, because I heard you say that, owner's capital is actually the most expensive capital.
So when you said 15, my shackles went down.
Yes, I noticed that. Let's talk about that.
No, I think it's very, very expensive. When I say something, then I need an hour to explain, because you'll immediately say, what nonsense.
We have time.
No, all I want to say is, if you're working out your cost of capital, my opinion is that whatever your cost of debt, when you attribute a cost to equity, I think at least put 3 times of debt.
And can we make it a little more tactical by sharing?
It'll become a training session.
No, just by sharing maybe like one company's example that
No, I won't name names.
Okay, so because in your book I read about Dhirubhai Ambani's story in terms of being a good capital allocator. Can we talk about like the financial discipline, or like what goes into the makings of a good capital allocator?
The capital allocator, back to personal finance, which I stray away from.
Okay.
My forte is business.
No, in terms of applying to your business.
So this is what I'm talking about. Recognize cost of capital. When you start allocating capital, start making sure, are you buying performing asset or non-performing? If you're buying non-performing, for heaven's sake, make sure it is an essential non-performing and not a non-essential. And if you have accumulated along the way, then try and see if you can convert non-performing to performing. And if you can't, then please get rid of it ASAP and release the money blocked in it and bring it into circulation. That single act can take the profit moving upwards.
And what have been some of your most favorite turnaround stories?
Real life?
Yeah.
Oh, there are many. My own clients. I'm working on a TV show. Maybe I'll bring them on that. So one day. So we are trying to work out like a Shark Tank, better than a Shark Tank kind of a thing. It's not giving money. Because if most businesses that fail due to bad finance management, and we can help prevent that. So we want to get cases on a live show, analyze their balance sheets on a live show, figure out what's wrong, get a whole panel of people saying, okay, I can put in over here, and turn around a company which otherwise would have shut down. And to start with, I've made a list of about 30, 40 of my own clients who, when they came to us, were in deep trouble, and today they are flourishing. And they've all agreed to come on camera. So we may start with some past cases, and then we'll invite people, okay, come to us and we'll handle. So this could be very, very exciting.
Yes. Can you share one example, only from the perspective of the audience understanding how to implement it in their own?
We only teach finance management. So people who've come, understood the mistake they've been committing, started rectifying those, and from a situation of deep trouble, they've now gone into a very comfortable position. So can't name names, not ethical. So
yeah, but any companies in the Indian context that have stood out to you?
Other than my clients?
Yes.
I often can't think of any like that. Not that I've not given it a thought, maybe.
Sure. So what are some of the pitfalls that you've seen business owners make?
I just mentioned some, short term for long term, not knowing cost of capital, accumulating a lot of non-performing assets.
And you also said less is bad and more is worse.
Yeah, that's a mantra of mine.
Explain.
I just told you actually. Less is bad, we can readily understand. If you have less manpower, then you need some functions won't get performed. If you have less installed capacity in your factory, some orders won't get executed. Or less is bad. Everyone understands that. What people don't understand is more is worse. Now we put a name to the more. Anything more is NPA. So if you have more, it's an NPA. What does NPA mean? The asset doesn't earn. But the asset has a corresponding liability which funded it, which has a cost. So that meter is on. So if your meter is on at 20% and if 1 rupee doesn't earn 20, then the second rupee has to earn 40. So the greater the non-performing asset, the bigger the burden on the performing assets. So less is bad, more is worse. So name of the game is optimization. But people realize the problems of shortages, but nobody realizes the problems of excesses. I've often said that if imagine you have an international order, you're a manufacturing company, it's a very prestigious order, and halfway through the execution of the order, you run out of raw materials. I think the purchase manager will probably get the firing of his life. Didn't you realize what an important order this was? How could you not make sure? The poor guy, the lesson he learned was next time if I need 100, I'll never keep 90. I'll probably keep 150 on the safe side. When he kept 90, he was fired. When he kept 150, nobody even questioned him. There's a comfort. Oh, there's extra. But you don't realize the price that you pay.
And because a lot of these times, a lot of the startup founders are, building their first companies. So they might not really understand how to even build financial discipline in the company.
Oh yeah. If there is so much of ignorance among the biggest of companies, you can imagine what happens to startups. And startups is worse because at least the large companies realize, having burned their fingers, that I need to. And they spend the money to acquire this understanding. Startups can't. They're struggling with limited money. And whatever money they have, they're right now going into if they're a tech company, they're putting everything into tech, and understandably. So, but unless they also give a thought to finance management, by the time they realize how important it is too late. I was addressing an incubators conference some time back, a very, very large conference. Some 450 incubators from 14 countries were there, each having thousands of startups. And at the end of the session, of course, there was a huge discussion amongst us, and still many of them are in touch with me, that how do we make sure these guys, and rightfully they don't have the money at that time, and they won't want to allocate money for something as something like finance management understanding. They don't even understand how important it is. If they keep an accountant, they feel my finance management is taken care of. So the thought was maybe the VCs should insist, before I release the money, you got to go through a program, learn and come, maybe something like that,
Yeah, because, a lot of founders are actually clueless in terms of what does finance management even look like, right? Any advice to startup founders?
Learn finance management.
How does
the cheapest and easiest way is maybe read my book. There are expensive ways and there are cheaper ways also.
Yeah.
So if you don't have time to at least read that book as if your life depends on it.
But if you could share some of those insights over here.
I've already been doing that.
So what would the framework be that startup founders should adopt?
But they must understand what is finance management, the ability to understand the financial implication of your actions. So any action taken after evaluating the financial implication is a financially intelligent decision. And if most of your decisions are financially intelligent, then your organization will be financially intelligent. So all you need to do is acquire that. You need to understand the impact of your actions on, number one, the company's bottom line, and number two, on the cash flow. These are the two pillars on which your successful business stands. Ability to understand, ability to manage profitability, and ability to manage cash flow. So they should learn this in their own interest.
And when it comes to, thinking about cost of capital for them, with a lot of these founders end up raising equity, but then they sometimes also raise a lot of debt with this, right? So how does a founder understand the true cost of capital to the company?
One is he got to understand, and second is, even if he understands equity is expensive, he has no choice. At that time, they may not be eligible for debt. But they got to recognize there is a cost. You don't have to pay it right now, but make sure in the long run that equity investment is justified. But more important is, I think, when these founders give up too much equity too early in life.
Yeah.
They look back and regret that decision. You should guard it jealously. Let go kicking and screaming. Don't, at the first opportunity, somebody says, I'll put in money. And I think most founders you find who later on in life said, my biggest regret was I gave up too much too early. So, but all these things are part of financial education.
Yeah, why are we so far behind in terms of being financially literate?
Because, I don't know, I've been doing my bit to make people literate.
Yeah, because, money hasn't been an open discussion in terms of families and, bringing up kids overall. So, how can we inculcate this in the younger generation?
My new book is out last week. It's called Start Early, Finish Rich. It is aimed at finance management for kids and young adults.
Let's talk about it.
Just hit the shelves.
Let's talk about it.
No, this topic came out, so I said, this book has just been released. The idea is, I agree with you completely, this should be taught early. The reason I wrote this book is because I think almost every client of mine, somewhere along his interactions or her interactions with me, must have blurted out, why wasn't I taught this in school? Later on in life, by paying a price, I've realized how important it is. So you said, yeah, why not teach them early? So this book is aimed at, let's say, 12 to 20-year-olds, kids and young adults.
What all aspects does it cover?
I have not spoken down at them at all. I'm treating them like adults. I've written in the book everything that I would have taught a grown-up, but in a far easier language. The book has more illustrations to make it sound little unintimidating or something. But the content is, so it has 3 parts. One is some basic fundamentals. One is a section on personal finance. And one is, I'm assuming they'll become startups very early in life. So what should they know? How do you start? What is the business constitution? How do you raise money? How do you account for that money? What are the various ways in which funding can be raised? What are the tax implications? All that stuff is covered in that also.
Yeah, that's fantastic, because one example, as we were talking about the true cost of capital, was, I don't know if you're familiar with the Thrasio model, where, a bunch of roll-up companies where they were raising significant equity and debt financing to go and acquire other companies as a roll-up vehicle. And a lot of these kind of companies, because, they went on multiple acquisition sprees, came under so much debt that they weren't able to finance their interest even, and ended up shutting down. So this company was actually in the US called Thrasio, which started, and it became the world's fastest unicorn, hit $1 billion in valuation. Then the Indian founders copied the model, built 4-5 companies similar to that.
What are the name of the Indian company?
There are many that came. I won't name specific, but I'm sure, they've been widely written about. But a lot of them shut down already.
So I have these 2 golden rules. People take extreme views about debt. Debt is bad. Debt is not bad. Debt is one of the best things you can use to grow. So I have 2 golden rules. I feel your problem arises because you violated one out of those 2 rules, or both the rules. If you don't violate those 2 rules, then the more you borrow, the more you will prosper. And one of them is what you said just now. Make sure when you raise money, you borrow money, you're borrowing it for a purpose. So wherever you deploy it, if you can earn greater than what the debt costs you, that's not enough. Debt comes with an obligation to return. So where you invest should bring it back before the debt has to be paid back. If these 2 conditions are not violated, the more you borrow, the more you will prosper. As you said, these guys didn't even earn enough to pay the interest. So that rule got violated. So any debt, unproductive debt, absolutely no. But productive debt, I get an opportunity. I need to invest 10 crores in that. But if I invest 10 crores, I can earn 30 crores. I don't have 10 crores. So my option is I let go the opportunity. Or somebody says, I can give you the 10 crores and I charge you 10-12% and I can earn 30%. Now, should I say yes or no? It's a no-brainer. Of course, I'll say yes. And provided I get it back before I have to pay it back. So imagine I have zero. People ask me, what kind of debt equity? I said, why the hell are you worried about debt equity? Let the banker worry about it. Let him say you've exhausted your debt equity. If you give me a debt in the ratio of 100 to 1, I'll take it. Provided I can invest it in such a way that I can earn more than I have to pay you. And it comes back. So these two rules are sacrosanct.
Yeah, because in India, we're always told that debt is bad. Stay away from that.
These are all mindsets. So I've often quoted this. Some interview was going on, I think on ET now. She said, what do you think of companies that say we are debt free? I said, were they boasting or were they apologizing? I mean, I don't understand. People say I'm debt free, meaning debt is the cheapest money. So either you're saying I've stopped growing. That gets me worried. Or you're saying, no, I'm growing, but all the money I'm raising is from equity. That means I'm going to take expensive money. So if you can afford expensive money, how is it you can't afford cheap money? I mean, that's such a ridiculous way of putting it, isn't it?
Yeah. That's truly first principles thinking, but I think, people get lost, things get lost in narratives, right? Because, all debt is bad, and that's how we bucket things.
Correct.
So, just my last questions around, in terms of if there were some frameworks that you wanted to pass on to younger generations in terms of, what they can do better, which, possibly my generation couldn't do as well and maybe not yours. But how can we build
I keep repeating like a broken record, arm yourself with finance management knowledge. That will hold you in good stead throughout.
And what about on the investing side? Because I heard you talk about compounding and,
all that is part of finance, understanding finance. So unless you understand principles of compounding, how do you use them? A simple example if I give you is, let's say I'm running an airline. I have a flight right now leaving from my home city, Pune, to your Delhi. And I have a 100-seater aircraft. And I fill fuel in it, say 500,000. Cost of fuel, 500,000. Number of seats, 100. So per seat fuel cost, 5,000. I may spend a little more on the passengers, give them a soft drink, give them a sandwich, another $300. So now a seat costs me 5,300. And I decide to price it at 9,000. Pune-Delhi flight. Now the flight is about to take off. 100 people are not there. 50 people are there. And one fellow come running last minute, bag in hand, please take me also. But I can't pay 9,000. Now how much should you sell the ticket to him for? Your cost per seat, 5,300. Your selling price, 9,000. This guy says, can't pay 9,000. I can pay 1,500 bucks. Now should you take him on or not? Grab him. Don't let him go. Because you still generated a contribution of 1,200. That 1,500 minus that sandwich and soft drink cost is your contribution. You made a loss. 5,300 seat you gave for 15. The profit is negative, but your contribution is positive. Why? Because 5,000 is not your fuel cost. That's the way you present it. Your fuel cost is 500,000, which you already filled it. And you're not going to fill a 5,000 fuel because this guy is coming on board. So this is the difference. That means if you're going to take off with 50 people, if already you were making a loss, you're now going to make 1,200 less loss if you accept this guy. And if you're making a profit, your profit will go up. Even though you sold on a negative profit, your profit has gone up. This understanding, not for happy days. Don't budge below 9,000. If somebody says 8,999, say no. But you can say that when you have a 100-seater aircraft and there are 150 people waiting outside. So, in tough days, this is what helps you. So many such things are there which help companies. So this is my understanding of contribution. I don't know how to divide it into CM1, CM2, CM3.
Yeah, I love that because, this is definitely the way for businesses to navigate tough times also, right? To bounce back from challenging times. If you focus on contribution and if you get that right, or the other things sort themselves out in some way.
They do.
Yeah.
They do.
Contribution, according to you, that's the best part to focus
No,
on?
I've told you one out of a few hundred things. So we need to sit for 3-4 days in a room and then...
For that, I'll definitely attend one of your training programs next time, Anil. But thank you so much for joining us today. This was a fantastic conversation.
It was a pleasure speaking
and
with
I
you.
think the viewers will really benefit from your advice.
Thank you so much.
Thank you. Thank you for tuning in today and watching today's episode with Mr. Anil Lamba. Hope you enjoyed watching. If you enjoyed our content, please remember to hit the subscribe button. It helps us in bringing you even better guests.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.